what's going to take the lead in the very near term, in the middle term, in the long term? Who better than Ajay Srivastava from Dimensionals Consulting to talk about exactly that? Ajay, hi, morning. Great to have you on the
Good
show.
morning.
Ajay, the latest chink in the armor, the fuel price hike. But I guess this is something that the market is already baked in, right?
I do not know baked in or not, but it hurts from because you start to pay from today. So
Yeah.
I don't know what market, but an average person has to now shell out much more than what he was doing yesterday. So, in a manner of speaking, I think the real purchasing power started to go out from today, from the consumer's pocket. Baked in, yes, no, because I don't think so. Any of us, I'll be honest to you, has any idea what's going to happen in the next 3 to 6 months as this whole oil price shock, West Asia shock, FPI is out, Rupee at 96, all starts to come into the system. Right now it's just too early for the system to react, but I think let it flow through because whether it's foreign currency loans, whether it is going to be your imports, whether it's going to be your consumer baskets, I think it's going to take time for us to understand the impact, and none of that looks to be greatly positive. You may say markets corrected, but I think we may be in for a few surprises down the summer.
So, Ajay, as an investor, what is it that you should be doing right now in your portfolios?
Reallocate, reallocate, reallocate. The only thing we're telling investors, and I think anybody who meets me says, why do you keep saying that? And I say, listen, you need to just keep diversifying at the end of the day, because whether we like it or not, okay, our economy is quite it's very domestic. It's kind of so much more impacted by what's happening domestically compared to global economy. So I think it's now a cliched theme that go invest globally. We have much higher allocations for gold and silver for our investors and advisory, because we have always believed that we should be much more than the 5% earlier model being touted for the last 2 years. So I think, this is the stage where you need to buy into stocks and areas which you never had. I think that's the key. Number two is go after legacy. Legacy companies do extremely well in turbulent time, whether it is financial services, whether it is consumer, whether it is industrial. You will find that the legacy companies have performed the best. I'm giving example, not quoting. You see CG Power, you see ABB, and you know what I'm talking about it. And you have to go back to the thesis that Indian executives today in MNCs and other PE-led companies are a very complacent lot. It's only where promoters directly involved you see performance. So I would say, forget everything else. The metrics is deep performance or involvement of promoters who are good quality promoters. That's the segment and industry you got to go to. So sift out the rest, because they're not going to they give you returns. And you saw what happened in HDFC Bank and ICICI Bank. Those have just not made any sense to any investors. So focus on promoter-driven companies who are doing well in each sector. Could be engineering, industrial, materials, financial services, name it, auto ancillaries. Promoter-driven companies is the way to go.
Ajay, has the thesis, has the take on IT shifted at all? That's one play which is contrarian, which is largely what you're known for. Give us a sense as to how you're looking at IT, broader basket, and also niche IT, because currently everything IT related is beaten. So could there be opportunities, like you said, in some smaller names which could crop up, promoter-led?
Oh, no, not at all. Not at all. Just
Okay.
If you want to buy IT, I'll tell you one thing. Just go buy US IT companies. We had a big boom IPO yesterday, Cerebras out in the US at this point of time. The themes are there. And I'm so glad that the first industrialist who actually named this problem yesterday was Mr. Mittal. I think he said it very clearly that something needs to be done to these companies. So I don't think so. These companies have a future with these management. They're not going to do anything for you. They have run out of ideas. They're still giving dividend in the current year. Thesis has remained the same, that these managements have run out of basically runway to do anything different. And number two, the beauty, you're getting so many new themes in the United States at the end of the day. Why would you put a single rupee in that body shopping model of Indian IT versus the high tech that you're getting there? And imagine new IPOs you're getting there still. You still have got AI companies, private placement going on. You got a lot of stuff happening in the US. Why would you put a single rupee within Indian IT companies? Sack this management, and I promise you I'll put my first money there tomorrow morning.
Interesting. Ajay, on your point about diversification, though, I mean, if someone realizes that now, I mean, are these the levels to invest or even up allocation into US equities?
Well, he just has to do one comparison. Just compare Walmart PE versus the PE of DMart. and he will understand the answer. You just compare them. That's all. Don't do anything. That, this whole concept of that, has the, global indices run out of steam, etc. If you can invest in India at 70, 80 Ps, my friend, there is no reason why you should not be putting money there, where you at least know 3 to 4% dollar return you will get in any case, rupee dollar, plus those companies that are P of 25 and 30 and below, all are below 30 and thereabouts at the end of the day. So I would just say, pick up any sector, look at consumer sector. Just look at Unilever India, look at Unilever Global. Just see what's the PE difference and you know what you're paying for in India. So to all the people who keep saying, the market's gone up 80%, 90%, but still NASDAQ is historic high, just compare the PE of the stock you buy in India versus anywhere in the world and you'll get your answers. Don't take my word for it. Just do the PE comparison.
And Ajay, point really well taken. How should one look at pharma then? Because even pharma, you can put out the same argument, but the Nifty Pharma is at an all-time high.
Yeah, but Nifty Pharma has, underperformed for a fair bit. And pharma has got various segments. So it's unfair to put pharma. There is a typical Indian generic pharma companies which got left behind at the end of the day. And you see the returns have not been any spectacular, whether talk of Sun, whether talk of Cipla, whether talk of, walk hard, look at the 5-year return. And you're talking of CDMO, CRDMO companies, of which one happened to be director of one of the large companies in India. Those have a different animal altogether. Those have done reasonably well. So I would still say, sectorally, it's a good place because a lot of exports, rupee dollar benefit. Most of the companies, not most, but literally all, are debt-free companies, strong cash flows. And you saw one large acquisition happening just now by Sun Pharma. So very stable, good sector. Export earning will give them benefit. Now, whether it performs extraordinarily, which part of it, the generics, the biologics, the CRDMO, you can choose. But I would tend to believe that export-driven companies in pharma sector would do very well for the next 3 to 5 years, because I think that China and +1 was a wrong number, but India is a good on its own outsourcing. So it's a very safe place to be, but you have to pick and choose your companies at the end of the day, because not everything is going to shine. And therefore look at, again, I keep saying, promoter-driven companies. They will deliver performance out there. Even look at the CRDMO space, etc. You will see the very clear difference. Promoter has made the difference in all these companies.
Yes, and there's proof in history for that. But Ajay, great to have you on the show.
You're welcome.
Thank you
have
so
a wonderful
much.
day.
You too. Thank you so much for your time. Diversify and stick to promoter-driven companies. That's where you are safest, and perhaps scope of alpha generation as well. Let me